Hello and welcome to this podcast, where we're going to dive into one of the most important aspects of personal finance, how you can secure your financial future and work toward becoming a Crorepati by the time you hit 60. Now, becoming a Crorepati is a goal many of us dream about, but it's crucial to start early. If you're in your 20s, you're already at a great advantage. The earlier you start investing, the better the power of compounding will work for you. But with so many investment options available, it can get confusing, especially if you're just starting out. In this podcast, we will explore several investment options that are both simple and effective, with a focus on how you can start at the age of 20. And by the time you reach 60, you could have accumulated the wealth you need to become a Crorepati. Let's dive into the different investment options available in India, their types, and the pros and cons of each. Option 1. Equity, stocks. Equity investments are one of the most popular ways to build wealth in India. By purchasing stocks or shares, you own a small part of a company, and as the company grows, so does your investment. Types of equity investments. Individual stocks, buying shares of a specific company. Equity mutual funds. Investing in a collection of stocks managed by a professional fund manager. Exchange-traded funds, ETFs. A fund that trades on the stock exchange, tracking a specific index like the Nifty or Sensex. Pros. High potential returns. Over long periods, equities can generate returns higher than most other asset classes, potentially even compounding your wealth significantly. Liquidity. You can buy and sell stocks anytime the market is open, making them a liquid investment. Ownership. As a shareholder, you are part owner of a company, and in some cases, you may get dividends as a reward for holding shares. Cons. Market volatility. Stock prices can fluctuate significantly in the short term. This can be stressful if you're not prepared for sudden market drops. Risk. There is a risk that the company you invest in could perform poorly, leading to financial losses. Requires knowledge. To make informed decisions, you need to study the market or hire a financial advisor. Option 2. Mutual funds. Mutual funds pool money from various investors to invest in different types of securities, including stocks, bonds, and other assets. They are managed by professional fund managers. Types of mutual funds. Equity mutual funds. Invest mainly in stocks. Debt mutual funds. Invest in bonds and other fixed income instruments. Hybrid mutual funds. Invest in both stocks and bonds. Index funds. These track a specific market index like Nifty or Sensex. Pros. Diversification. By investing in a mutual fund, your money is spread across a wide range of securities, reducing the risk of losing everything. Professional management. Fund managers handle the investments, so you don't have to worry about the day-to-day decisions. Systematic investment plan, SIP. You can invest regularly with small amounts through SIP, which is perfect for someone just starting out. Cons. Fees. Mutual funds charge a fee for management and other expenses, which can eat into your returns. Market risk. While the diversification reduces risk, mutual funds still carry market risk, particularly equity funds. No control. As an investor, you don't have any control over the fund manager's decisions. Option 3. Real estate. Real estate has been a preferred investment in India for many years. It involves buying property with the expectation that its value will rise over time. Types of real estate investments. Residential property. buying homes or apartments for rental income or resale. Commercial property, investing in office spaces or retail outlets. REITs, real estate investment trusts. A more recent and liquid way to invest in real estate without actually buying physical property. Pros. Tangible asset. Real estate is a physical asset, meaning it can't lose value as easily as stocks. Appreciation. Over time, property values in India have generally appreciated, especially in urban centers. Rental income. If you buy property, you can generate consistent rental income. Cons. High initial investment. Real estate requires significant capital to get started, and it may be out of reach for many in their 20s. Illiquidity. Selling property is not as easy as selling stocks or mutual funds. It could take time to find a buyer. Market fluctuations. Real estate markets can also experience downturns, affecting the value of your investment. Option 4. Fixed deposits, FDs. A fixed deposit is a traditional way of investing where you deposit a lump sum amount for a fixed tenure and you earn interest on it. Types of fixed deposits. Regular fixed deposit. A single lump sum deposit for a fixed period. Recurring deposit. Small monthly installments are deposited in a bank. Tax-saving fixed deposit. A fixed deposit where your principal investment is eligible for tax deduction under Section 80C of the Income Tax Act. Pros. Safe investment. FDs are backed by the government and offer guaranteed returns, making them very low risk. Fixed returns. You know exactly how much you will earn, as interest rates are predetermined. Liquidity. You can easily break an FD, though you might incur a penalty. Cons. Low returns. Fixed deposits offer lower returns compared to equities or mutual funds, making it a less effective wealth-building tool in the long term. Taxable. Interest income from FDs is taxable, which can reduce the overall return. Inflation risk. If inflation is higher than your FD return, the real value of your money could decrease over time. Option 5. Public Provident Fund, PPF. The PPF is a government-backed savings scheme that is designed to provide long-term retirement benefits. It offers tax-free returns and is a favorite among risk-averse investors. Pros. Guaranteed returns. The interest rate is fixed by the government and is generally higher than that of FDs. Tax benefits. Contributions to a PPF are eligible for tax deductions under Section 80C and the returns are tax-free. Long-term growth. The PPF has a lock-in period of 15 years, which encourages long-term savings. Cons. Limited liquidity. You can't withdraw the money easily, except in certain cases. The 15-year lock-in can feel restrictive for some. Contribution limits. The maximum annual contribution is 1.5 lakh rupees, which may not be sufficient for someone aiming to become a Crorepati. Lower returns. While safe, the returns may not be high enough to match the growth potential of equity investments. Option 6. National Pension Scheme, NPS. The NPS is a government-sponsored retirement savings scheme designed to help people accumulate wealth for their retirement years. Pros. Tax benefits. Contributions to NPS qualify for tax deductions under Section 80C and an additional deduction of 50,000 rupees under Section 80CCD. Long-term investment. The NPS is primarily for retirement, and it encourages disciplined long-term savings. Choice of funds. You can choose between equity, government bonds, and corporate bonds based on your risk appetite. Cons. Lock-in period. NPS funds are meant to be accessed only after retirement, so early withdrawals are restricted. Complexity. The investment options within NPS can be confusing, especially for beginners. Market risk. The equity portion of your NPS may be subject to market fluctuations, making the return variable. Option 7. Gold. Gold has always been considered a safe haven investment, particularly in India, where it holds cultural significance. Types of gold investments. Physical gold. Gold bars, coins, or jewelry. Gold ETFs. Exchange-traded funds that track the price of gold. Pros. Hedge against inflation. Gold tends to hold its value well in times of economic uncertainty and inflation. Low risk. Historically, gold has been a stable investment with low volatility. Liquidity. Physical gold can be sold easily, and ETFs are traded on exchanges. Cons. Storage and safety. Physical gold requires safe storage, and there's the risk of theft. No income generation. Unlike stocks or bonds, gold does not generate income in the form of dividends or interest. Price volatility. While gold is generally stable, it can still experience price fluctuations in the short term. Now that we've covered various investment options like equities, mutual funds, real estate, fixed deposits, PPF, NPS, and gold, you have a wide range of choices to start building your wealth. Each option has its own set of benefits and risks, and the key takeaway is that there's no one-size-fits-all solution. As a 20-year-old, your focus should be on starting early, being consistent, and diversifying your investments to create a balanced portfolio that aligns with your long-term goals. Whether you're looking for safety, growth, or a balance of both, there are options for everyone. Take your time to explore these options, understand how they work, and consider speaking with a financial advisor if needed. And remember, the most important thing is to start now. The earlier you invest, the greater your chance of becoming a crorepati by 60. Thanks for tuning in, and happy investing.